In this video, we'll look at the Martingale trading strategy and how we can use trading bots to actually implement this on autopilot. I'll show you exactly how to set up one of these trading bots and then what this DCA or Martingale strategy actually is, and I'll leave timestamps for everything below. What is the Martingale strategy as it relates to financial markets then? This has been something pretty popular in Forex markets, but in crypto as well, we can actually implement this. The Martingale, otherwise known as DCA or dollar cost average, is actually a short-term trading strategy where you implement a set of buys during a downturn in the price in order to get a decent average price for a trade, somewhere around here. And then obviously when the price moves back up again, you automate that sell. So it's a short-term trading strategy where we try to essentially buy a dip and get a good average price for a trade within that dip. Now you can do this manually, but obviously setting up a trading bot to do this automatically with set prices to just buy certain dips if and when they occur, and then to automate a sell as the price goes back up again, that's something that we can implement. Now you can actually put all of these different parameters in exactly the way that you want to make sure that you buy and sell at the places that you want to. There are many crypto trading platforms that allow for these bots. Most of them do. So if you have one already, you can go and search for it. You can see Bybit here has a futures martingale, which is where you use futures. So you can take leverage if you want, and trading fees are a little bit cheaper. It's a bit easier to trade with size, but we'll just look with a spot trading bot for this example. So actually buying and holding the crypto. And that's good if we're looking to accumulate anyway. So we can buy, dips, and we can hold that position, if the position goes against us for longer than we think. I'll leave links to Bybit, OKX, and some other platforms I use below. You can usually get trading and deposit bonuses if you're new, so you can check the details via the links. But from here, spot DCA. And what you can see is on the chart, you can essentially place your buy and sell orders exactly where you want to take advantage of any potential dips as they come. So we can go ahead and actually implement this strategy and exactly tell the system where we would want to buy, how much we want to buy, and then any potential sale price. Let's have a look at implementing this strategy on the Bitcoin price then. And as we can see, during bull markets, each of these is a Bitcoin bull market, you get regular drawdowns of around 20 to 30%. So those should be expected within a bull market. Bitcoin bull markets are very clear to see. They're around 18 months, 2 years, and you can see an expansion in the price, higher highs, higher lows, and general uptrends. But within those, big drawdowns, and so that's something that we can implement. And crypto prices generally follow this as well in terms of their drawdowns and expansions, but obviously way more volatile. So we'll look at Bitcoin, and as we know, from a local high, we may get anywhere from a 20% to 30% drawdown. But of course, we don't know exactly where those occur, which is why automating the strategy may work. So you can see here within uptrends for Bitcoin, you do get these drawdowns. So this one was around 20%, this one here about 20%. From the local high right here, another drawdown of around 18%. And then recently, you can see these 2 weeks, these are weak candlesticks, 1 week in length each. This is around an 18% drawdown. So something where the strategy actually can work, because obviously this is pretty fast to trade, but if you have the strategy set up to try and take advantage of those dips, you can try and actually automate those buys. So let's go through this. This is the spot DCA or Martingale. On OKX, you can have these AI strategies. This isn't AI. They're just showing you the most profitable strategy that was implemented recently. So we're just going to go to manual just to see how we set this up. So you can see on the chart now, we have a bunch of these orders that are going to be automated for us. And over the last few weeks, this was a perfect example of where this type of strategy does really well, because you have a high price, it's an all-time high, and then you start to get rejected. And at that point you think, well, maybe we come down a bit further and we can automate some purchases here. So the good thing about Martingale is on this take profit target, you can set this short term. You can set this as a small target if you're looking to take dollar profits out, or you can just set this miles away from the price. And what you've done essentially is bought the dip and you're just waiting for a long time away. So you don't actually have to sell, like you can just cancel the bot at that point. But if you are looking to buy dips, you're probably just putting limit orders in. This is more of an active thing where you're looking to actually get an average price and then sell at some percentage to try to automate that and augment your investing. So what we can do here is set this up. So the price steps, this is the difference in percentage terms between each order. So let's go a price step of 3%. That means there's 3% difference in each order. So you can see that now. Take profit per cycle. I'm just going to do this a fairly decent amount away from the price. So what this means is the take profit target based on your average buy price. So of course, if the price comes down, our average price for the entries is getting lower as we come in and buy another set, the average price of our trade is coming down. When orders are filled and it starts to go up again, that's kind of an average price. Whatever your average price is, then your take profit target will be this percentage away from that. So if we get some of these filled, but not all of them, start moving up again, 15% from our average price is where it will actually sell for you and take out, the strategy. Now this bot is actually automated to refresh itself, which means it will keep working and actually keep buying dips and then selling at a set percentage above if you let it. So you can either let it run a long time, or you can actually cancel out the bot if you just want to have the bot running for one cycle, which is, one dip and then a recovery. So the investment amount, let's put an amount in here. That is the initial order, which is usually traded immediately. You can set this in the advanced settings to trade differently, but usually you will set the buy price immediately to get some of the order done and then let these other orders play out. They're called safety orders. They're just literally limit orders right down below the price. Safety order amount. So that's the amount per each of these orders as well. So if your initial order is 1,000, you can put each individual order down here incrementally at 1,000 or any other amount that you want. So you can actually start the initial order with a very small amount and then have the other orders down here at larger amounts. There's 8 safety orders for now, so let's change this just to 3 to make it a lot simpler, right? So you can see this strategy would have done well over the last few weeks where we have an all-time high, usually get rejection from that. We got rejected a little bit. There was obviously a seller in the market where it took us down. It's good to just automate that, to have a few buys in there and maybe either profit short term off that where you get the bounce back, or just to put the take profit take profit target a long way away to maybe just hold that crypto for later in the bull market. So as we come down here, you can see these order amounts are different. 1.47, 1.67, 1.019. Why is that? If we go down to advanced settings, you can see that here. So the start condition is instant, so we'll just leave that as it is. Now the amount multiplier and price steps multiplier, you should be able to see above my head. These are important. The price steps multiplier, we'll just leave this at 1, but if I change this to 1.1, you should see the safety orders change a little bit, and they got a little bit further apart. What's happening is the difference between each price step is 3% right here. But what this is doing is multiplying each price step by 10%, right? So 1.1, so that's 3%. And then the 3% difference on the second is actually 3% plus 10% of that. It's kind of making them exponentially, further away from each other. I wouldn't do that because what do you actually want the price steps to be? You don't want them to get kind of further away from each other. So I'll leave that on 1. But what the Martingale strategy usually is actually putting in more as the price comes down. So your initial amount or your initial order maybe is the smallest amount, and then each one is incrementally larger. So you'd have 1,000, 1,200, 1,500, and then 2,000 or something like that, because what you're doing is putting more in as the price comes down to get an average price that is lower. Because obviously the more you put in at a lower price, then the average price for those trades actually comes down. So you can do this if you want, or you can just set it for 1. So just 500 an order. So you would just put this at 1 and then put the amount per safety order right here. But this is going to multiply. So we're going to actually multiply this by 1.2. And you can see that the amount that we're buying, the limit orders in, are actually getting bigger as we come down. So that's up to the individual. So what we have here is the price steps, the take profit per cycle, if we want that, the initial amount, and then the amount per each additional order. We're going to start instantly. This is the price multiplier if you want to put that in. And then as you can see here, the stop loss settings. So if you are trading short term, you can put a stop loss in to say, if the price comes down to whatever it is, you can say, a 35% drawdown. You can see that right here. That would be the stop loss. So let's put that a lot closer at kind of 18% or something, right? So you can actually set up the entire strategy to say, I'm going to buy this dip, and if it comes down to some price, I'm actually going to sell at a loss to prevent any further losses. Now, that would really be important if you're trading in the futures market, because that's definitely short term. You have to be a lot more active there because you have the potential of using leverage and getting stopped out, which is a mess, and so you don't want that. With the spot bot, what we're doing here is saying, I'll take advantage of a dip if possible. However, we're in a bull market, and if I just buy some here, then maybe that's not a big deal for me, and I can actually hold it anyway. And so you don't need that stop loss target. You can just put 0 or no stop loss, because if you've got the cash to buy it and settle it anyway, hey, it's a bull market, doesn't matter, I'll just hold it and wait, or just put it into my investment stack or anything like that. So that shows you how to actually set up a sort of active buy the dip trade, which happens very often in crypto bull markets.